And good evening, everybody. This is Michael Filighera. I am with logicalsignals.com and tradershelpingtraders.com. And this is the Elliott wave update for the S&P 500 for Sunday, July 25th, 2021. Again, being that it's Sunday, it's going to be a little bit longer update because now I'm going to take the opportunity to take a peek at where we are at versus the large picture. And within the largest picture that I can create for the S&P, for the ES, is on a cycle degree. But when I move this out and I'm looking at the SPX, which is the cash market, I have a much larger picture, which still continues to demonstrate that this is finishing a cycle degree fifth wave. But it's only then once 1 degree up, it's a super cycle degree third wave. So what that means is what we're staring down the barrel at is a super cycle fourth wave correction. And more than likely, it's going to resemble the cycle degree fourth wave correction. Because we still have a fifth wave, which is still a bullish upward move, we're now just probably going to go through a very long period of consolidation, but basically be range bound. The last time this occurred was from 1999 to 2009. So there were quite a few things in between. And if we did the balance against the S&P versus the Dow, during this period of time, the Dow at this point went and created a new all-time high. Then the S&P did not, but got, oh yeah, it did actually. No, it didn't. It got very close, but it did not create a new high. Still, it was an irregular B wave. So it produced a flat, see how flat that is? But deep, flat, but still powerful in terms that it was dropping from 1500 back down to 665. Quite a steep drop during its financial collapse of late 2008, 2009. But it was a great corrective move. Now I'm looking for a super cycle degree fourth wave, which will likely move into the price territory of the fourth wave of one lesser degree, and that's this one right here. So if we're just following the rule of alternation and we're following how Elliott and Fibonacci work, it is going to direct us back to this level for a correction. That's quite a bit. So essentially we're saying that, okay, we're going to take the last 12 years and get rid of them because that's what we're correcting. We're correcting a much larger time frame, but this is really the move that was added onto that already. So that's what's going to get corrected first. And that pretends right back to here. So more on that as it progresses. So as we're going down, we're still in that cycle degree fifth wave, which is going to have 5 waves, a primary degree, which we can count out 4. 1, 2, 3, 4. That takes us to the March 2020 lows. That was the end of primary wave 4. That's where we began to count primary wave 5 up. And let me go out to the weekly just so that I can be a little bit more precise. And within that, there's cycle, there's primary 4. So within that now, and this primary fifth wave advance, we have 5 waves of intermediate degree. And with inside those intermediate degree advances, we have 5 waves of minor degree. That's what we need to count. But here's intermediate 1, intermediate 2, and then my minor degree, 1, 2, 3, 4, 5. That takes us up to the most recent highs, where we completed intermediate wave 3 of primary wave 5 up. Okay, now I'm going to go down again, and I'm going to go to the daily. Now we're within. There's 1, there's 2, and then here comes the third. 1, 2, 3, 4, 5. So you can see the distance. We traded. If you trade, I did. We traded all of this, but I started making updates right in here. So we're getting pretty far, and we're continuing the uptrend. Now we've already established that it still remains an uptrend back on a cycle degree level. So now you know what we're counting up, each division on the way up. So we're within the final intermediate fifth wave, which will complete the primary fifth wave, which will complete the cycle fifth wave. So we are reaching now up into that level. Now, that's on an intermediate. We just went over that. So now we're going to go down inside this intermediate fifth wave, which began right there. There's the 4. And what we have now, 5 waves of minor degree are required. Here's minor 1, minor 2. So we remain within this minor third wave. Fair enough. Within it, minute wave 1, minute wave 2, and then minute wave 3 subdivides in and of itself. 1, 2, 2, 2, 3, 4, 5. Possible. So 1, 2, and then subdivides again. 1, 2, 3, 4. 1, yeah, I don't like it. 4, 1, 2, 3, 4, 3, 4, 5. That would put the cap on minute wave 3. If we're in a minute wave 4, well, we could probably drop back to 43.88. We could run a Fibonacci retracement from the bottom of where this internal third started. So we're running it from 43.09 up to 44.08, so 100 points. So 32 points basically brings you back to 86. Well, we got the 20-day moving average at 43.88. So that would be 1 point. Another would be 43.70. You could drop down to the 50 and still be in total perfect health to pick up the rally and run with it. So because I'm looking for this to probably be pretty shallow. And right now if I take it down, it's going to look like it's a little bit steeper, but that doesn't make any difference because it's the price. It is a zigzag. And so the drop right here now is $10. So yeah, 43.85. Sitting right, staring us in the face on the 30-minute chart. In any case, I still think then we will have an additional rally. And this next level up third wave will probably likely come in here. 14,415 to 14,440. That's where I kind of believe that will kind of come in and finish the third wave. Right? 1, 2, 3, 4, 5 of 3. Then we have another 4th. Then we have another 5th. So we still must keep all targets in. And this one basically is just your first target for the wave 3, wave 4. So in other words, it's an intermediate 5th wave. Where does that pretend? We run extensions from the bottom where intermediate wave 3 started to the bottom of intermediate wave 4. And now we have projections for the next legs up. So you can see that we can get the power behind it because there's the bare minimum. And we could probably hit that easily. But here, 46.83, 48.24, and here's the 618. Now remember, what's the most common relationship between this? In an intermediate degree or whatever degree, the most common relationship between a 5th wave and a 3rd wave is that the 5th will come in 0.618 times the length of the 3rd. That projects to 4,967. You wonder how? Pick a reason. Primarily, I'm going to tell you as a trader, you got to buy a bunch of stock up here. You got to buy a bunch of futures up above these levels. Never been here before. And you need 100. Well, I can't sell you 100. So you're going to have to go out there and they're going to push this thing higher. And they're going to run out. They're going to run out of sellers because even the sellers need to do, if you're an option trader, you're going to have to sell something. You need to hedge it with a buy. And if you're chasing the buys, things start to dry up as things become more difficult to fill. So you're going to get bigger moves. as this volatility increases simply because we're in uncharted waters. And there's still a lot of business to do versus all these earnings yet to come out. If they all blow the doors off, wow, you're talking like you need to buy how many? Well, I'm going to stand by and try to catch maybe a piece of it because I'm going to try to buy it in front of you. And that you'll see happen as well. So there's a lot of things that could really carry this thing higher. And I'm not going to, it's more, you can talk about that during the day or come to my trade room. Come and join the trade room. That's how I talk over there, because we need to understand that there is power in the market, and it doesn't necessarily mean that, oh my God, everybody's turning bullish. It's like, no, there's a lot more reasons to turn bullish. You're turning bullish because your P&L is sinking through the floor because you sold it. And we as day traders in a particular product, just the S&P, we're not running out to hedge that position. So we can't even limit our risk. And when you're trading like that, you're going to have to double trade and triple trade because you're going to have to trade out of that because this thing's going to remain volatile. So you're not there to really build a position. You're there to just kind of move in and out of the market easily because you're a day trader. Well, day trading, be careful. Pay attention to your moving averages, even down to the 1, the 2, the 3, the 1, the 2, and the 5 minute. And then pull in your 15, your 30, and your hourly, and don't forget to peek out at that daily. When you're getting moving average changes on a daily chart, that's going to give you a lot of news in terms of what the direction on the hourly and the 30 and on down should be. So you're if you're getting a directional change, your moving averages on your hourly or your daily, you're translating that down so that they're going to tell you when you're just going to get a little bounce, but the trend has changed, and that's where you're going to find out first. Okay, so tomorrow, I'm really thinking that we're gonna bottom here. We will, I believe, rally, and we're going to get ourselves up into this zone, and that will complete the internal 3 of 3. Then we're going to pull back again, and then we start to blast. And I'm thinking Wednesday, and I know somebody else called Wednesday as an area for top, Wednesday, Tuesday, Wednesday, Thursday. And it is kind of reversing some of that. Not reversing it, but just saying that it might just be a point where you dip down, but it blasts higher yet again. And that is all possible. Don't forget, we do have Apple on Thursday. So a lot of stuff going on. And for all I can tell you right now is that internal 3 of 3 move may just be extending again in and on itself. And it's just going to finish it here. Put an internal 4th wave, right? Still within that minor 3, 1, 2, and this finishes the 3 up here. We do a 4, and the 5 gets us even higher. And then we pull back again, and then blast one more time. It still all fits. We still can get way up there to 4,500. So I am really kind of considering that the corrections should be shallow, but hey, shallow right now still could be $13, $14 in the S&P. As a day trader, you don't want to sit that out. Why? In one position or the other. You don't want a market to go that much against you on a day trade. You want to shift, you want to change. Okay, but I do believe that I'm not expecting any great fireworks to the downside. If should they, then we're going to start seeing this thing break moving averages on the hourly. That's going to produce a little bit more time for that correction to do what it needs to do. Otherwise, upside, we get up into that zone. And then we start completing this minor third up above all of this. So we're still completing the internal 3 of 3. And I think that's what gets up into this upper zone. Then we pull back again as a part of the internal larger third, and a 4, and then a 5 to complete that minor 3. So I'm looking for still some pretty good strong upside. And that'll be it for today. The next update will be on Monday, the 26th.